pro-business environment. And as an economic historian, many of you would remember the first Bank of the United States was in Philadelphia. Philadelphia was the economic capital of America, and it moved to New York. So things can change. Florida, I think 2009, 2012, I moved to Miami. Everybody said, oh, you've gone to the beach. And I said, no, I just didn't want to pay any state income tax.
Right.
And now everyone's in Florida now. Florida now has more assets under management than Connecticut. So I think it'd be good for Dallas and Texas just to take in productive private capital rather than government agencies.
All right, well, good. Well, at least they pay property taxes. And so, well, this morning we all woke up and came in and you just addressed it on the tariffs. It was a 6-3 vote. When you initially saw that, were you surprised? Is that something you were anticipating, that the vote would go the way it did? Or I know you mentioned a lot of the things that they didn't vote on, but did it kind of go the way you thought?
I was a little surprised because I was in the Supreme Court hearing. Mercifully, I am not a lawyer. When people say, how do you like D.C., I said, there are too many lawyers. But I think that what we saw was just a very narrowing of the definition of a president's ability to use IEPA powers. So for those of you who saw the president earlier or have been following this closely, and when I was in the private sector in my investment business, it was very good, separate signal from noise. And a lot of the noise is what defeated. Mm-hmm. The only thing that was defeated is the ability for IEPA to collect even $1 of revenue. President, and I was at the hearing, and the justices agreed, and even the plaintiff agreed, that under IEPA can install a full embargo. He just can't collect $1 of revenue. So, as I said before, the one tariffs that have withstood more than 4,000 lawsuits since the first Trump term. There is something called Section 122, which President 5 months to install, to put a global tariff on. So President A is going to put a global tariff of 10%, and a number of 232 and Section 301 tariff investigations will be started. Those take a number of weeks and months to implement. So I can tell you that the total revenue that Treasury will collect this year will be little changed, if changed at all.
So you've already collected around $175 billion or something?
Well, that's under the IEPA tariffs.
But is that going to be in dispute? Like, who gets it back, or what?
Yeah, it's in dispute. Supreme Court did not rule on that today. They pushed it back down to the International Tax and Trade Court. Right. And my sense is that could be dragged out for weeks, months, years. So we'll see what happens. But the look forward, no one should expect that the tariff revenue will go down. And last year, the existing revenues, under the 232s, under the 301s, and some other collections were roughly equal to the IEPA tariffs.
Well, that's going to be a food fight going after $175 billion, isn't it? So
I got a feeling the American people won't see it.
Yeah. Okay. Well, let's shift real quick and talk about kind of the shadow banking economy that's happened, because in the country right now, Blue Owl, people like that have come along, that there are a lot of commercial bankers in here that are now having to compete with unregulated capital out there. What's kind of your view on how that's grown so much in really the last five years or so, and that's unregulated outside of your peruse? So
yeah, so it's really been about 10 years, yeah. And I think a lot of it. And again, I was also a financial institutions analyst in the early part of my career, so I followed the regulated banking system, the insurance companies, S&Ls when there were S&Ls. And I think private credit developed as a regulatory arbitrage because post Dodd-Frank, the regulatory straitjacket around our regulated institutions was so tight, making loans became very difficult. The big got bigger. We lost more than 50%, 50, of our small and community banks because it went from too big to fail to too small to succeed. Mm-hmm. And you know, I think like this growth outside the system, at Treasury, we have been pushing for loosening of the regulatory straitjacket. Oliver Wyman's words, not Treasury's. They believe that our changes in regulation, that I don't change the regulations, I guide them through a convening mechanism as the chair of the Stability and Oversight Council, but OCC, control of the currency, FDIC, and the Fed, that's probably 2.5 trillion of new borrowing capacity. So 2.5 trillion of new borrowing capacity for the regulated industry. So now private credit competitor. What we're concerned about, or what focus is, doesn't have to be a concern, is what is the relationship between private credit and the regulated sector. So our private credit funds borrowing from the regulated sector. You saw there was a transaction yesterday where Blue Owl sold a tranche of their loan portfolio to 3 pension funds and an insurance company. Mm-hmm. So that's moving it into the regulated industry. And you see almost every one of the private credit companies has a regulated entity. So now Treasury gets involved. So I am concerned with watching how does this get to the regulated financial system. I, as maybe some people in this room did, successfully predicted, and unfortunately successfully predicted, the subprime crisis that then turned into a banking crisis. And you could see like these CDOs and exotic instruments on bank balance sheets. So our job is to make sure that the regulated system is not affected by private credit. And we'll see. I think the private credit has been an exciting new feature. I think it bridged the gap, especially during the tough and tight regulatory times. I think that they were there during COVID when some of the banks were frozen, and I hope that they've been prudent in their loan portfolio.
But a lot of the private funds are doing stand and pretend. We see that a lot in the real estate industry, where a commercial bank would have to call a loan and they're pushing out. And then even in the private equity side, the continuation funds that they have that aren't sunsetting, they continue them on. Isn't that just kind of pushing problems off into the future that, as a Secretary of the Treasury, you kind of have to look at it and go, what is really going on behind the curtain that you don't really get a chance to look at?
We have the ability to peel back the curtain, and
even on a private equity deal.
Oh, sure. Mm-hmm.
Okay. Be careful. A lot of them are out here. Don't forget to do that. Yeah. So.
Yeah. When you get a call, the Secretary of the Treasury wants to come and see you. You return the call.
Get that.
But again, that we want to gauge, could it have any effects on the overall economy? Thus far, it's been very additive. But again, how does it affect the regulated system? And we want to prevent contagion. The other thing that I would say, and everyone in private credit, private assets, should listen to this, because at Treasury we are part of the rulemaking process for private assets going into retail. And this administration, led by Treasury, is committed that the individual investors will not become the dumping ground for residual.
And you're talking about the 401k plans.
The 401k plans specifically.
Right.
If there is something rotten, it is not going to be handed to the individual investors. And we are 100% with my colleagues at the Department of Labor committed to that. And look, it's to everyone's advantage that should individual investors be able to diversify into private assets? Definitely. But if the timing is bad, if there are a set of malactors, if intentions are bad, then it will be one of these things that it will be blocked for a generation. So we want to do it in a safe, sound, and smart way, both for the private equities and, most importantly, for the American investing public.
Well, Wall Street's looking at this. Trillions of dollars are going to be unleashed. Yet normally, they weren't able to invest in real estate and things like that. So there is a thought that valuations in hard assets are going to go up because now people have access to a small dollar go in there. But you're right, are the fees laid on it so heavy by the big firms and things like that? But you can't really regulate that.
Can't regulate that, but what we can think about, some things to think. Perhaps private investors shouldn't get a continuation fund. Mm-hmm. Like if you weren't in the original fund, then a private equity firm shouldn't put 401ks into a continuation fund. Mm-hmm. If there's a credit that's already in your private equity business and you do a follow-on loan, then maybe that's not appropriate. Mm-hmm. Maybe just de novo loans to new entities would be more appropriate. Well, so again, we want to make sure that the 99% of good actors do not get polluted by a couple actors that seems to happen every couple of decades.
So let's go back to banks for a second. I've served on some smaller regional banks here, and so many have been in the past have been rolled up, and then really mergers until the Trump administration came along had died for 4 years, and people doing de novo banks, that's kind of gone away. So what's your view on the banking system in the United States? Do you feel like it should consolidate around a few very, very large banks, or do we need to have a lot of regional community banks that really have kind of built the country?
Yes and B. What's happened, again, I think the regulatory morass just got too big to fail, too small to succeed. One of the things that I've been working on, and it's both sides of the aisle, and it's Senator Hagerty from Tennessee, Senator also Brooks from Maryland, are pushing for small and community banks to have an enhanced non-interest-bearing account, each depositor fund, and where there's a much higher level of deposit insurance. Let's pick a number. It's like $10 million right now. Because
where is it today? It's like 100,000?
250.
200. You want to take 250 to 10 million for a single account?
For a single account, okay. Non-interest bearing, and I'm informed by this by what happened with the deposit volatility during 2023, when we had the second, third, and fourth largest bank failures, despite Senator Warren's regulatory morass. I always say she's a financial agoraphobic. Right? Like, how do you not get hit by a car and never come out of your house? But this high level of regulation, don't make any loans, you'll never lose money. But somehow, with all these regulations, all this, the overbearing supervision, we had these bank failures. But what happened during those bank failures was the money ran to the very largest banks. And I'm saying that, like, even U.S. Bancorp, which I think is the fifth largest bank, lost deposits to J.P. Morgan. So like this moral hazard of the biggest banks, or the public believing that the biggest banks have insurance in a crisis, and then the money leaves the smallest banks, and the money that leaves the smallest banks, for any of you who have small businesses, for any of you who are on the boards, own smaller community banks, it's usually a payroll account. And it could be a lawn service company, it could be a restaurant, but payroll account can be several $1,000,000. And that moves to Wells Fargo, because they believe that government would not let anything happen to Wells Fargo. And payroll account then ends up there, and Wells Fargo are smart bankers. So they said, well, why don't you, we don't like just having the payroll account, bring your other accounts over, and then all of a sudden a community bank that's had the same client for 100 years, it's gone. Mm-hmm. So we think that this is a very smart and effective way to allow the small banks to retain business borrowers or high net worth individual or depositors over a long period of time. And these small banks are important. That up until December, I was a farmer. I was involved in the agricultural business, and I had to divest my holdings. And that sometimes on Saturday morning I turned on farm radio. You listen to farm radio, and I remember listening after all the bank, the bank failures in 23, and it's exactly as you would expect. These farmers are saying, look, these out-of-state bankers, they don't go to your church. They don't play Little League baseball with your son. They don't play softball with your daughter. You didn't go to high school with them. They're not in the local community. And I think there's nothing like these local community banks. They drive, I think 70% of real estate lending. They drive small business lending. And when you think, Wall Street versus Main Street, it's really time for Main Street to do better. And I think Main Street can only do better when the small banks do better.
Well, we're fortunate. You're probably the first Treasury Secretary we've ever had that listens to video. So I very much appreciate you understanding what's going on in the rest of the country. Now, real quick, this is a subject we could have had the entire hour to talk about, but I'm going to break it into two parts, and that's AI. One is the investment in AI, and the other is the effect of AI. And so I'm going to start first with the effect of AI and the kind of slow fire we're going through in this country right now. Because if you're graduating from college, the biggest unemployment bubble right now is kind of 19 to 28-year-olds really not being able to find a job. And then people are holding on to people longer, wondering what the effect of AI. So that's kind of, I think, a lot of people in this room, our businesses are like, what is this AI really going to do? And then secondly, maybe we can talk about this huge investment that's going into AI by companies that, different than the internet time when money went into stuff like pets.com that really didn't have a market. I mean, these are real company money up. So you can take either one of those you want.
Yeah, so I'll take both of them. One, I think it's very hard to disaggregate what's the effect of AI and what's the effect of the COVID employment over. Okay. Because I'm sure anyone in this room, employee retention during COVID was dire. I mean, my firm, we started paying quarterly or mid-year bonuses for the first time ever for employee retention. When I left just over a year ago, we'd stopped that. But I think as you said, slow to fire, slow to hire. Very optimistic about the overall labor market right now. I'm very optimistic about the economy. That historically, when I used to have to analyze economic data to make market bets, I always found that you were going to see an acceleration in the employment market when the temporary staffing companies did well. And temporary staffing companies are now reporting their earnings, very good demand, and historically that morphs into long-term demand. We've also seen about a 12 or 14% capex boom in 2025. CapEx booms are followed by labor booms. So, we'll see what the effects are of AI. You'll probably be able to figure out who I'm talking about when I give the breakdown. I had a major credit card company, Treasury, about a month and a half ago, and I asked the CEO, what is the effect of AI on your business? And he said, well, on our collections and billing department, we're definitely taking down employees, but we're moving them all to the travel department. So it may be a reallocation. And maybe in a different world, travel would have been hiring. So, but just with that particular anecdotal example, the employment's flat.
How about on the investments? Does that worry you at all, this big, massive amount of capital that's being allocated to that? Because if you look at it as part of our GDP, it's a massive percentage, probably more so than any other industry that's as a startup in history.
Well, I think a very good way to frame it is approximately every $300 billion is 1% of GDP. So every time when you read that there's going to be 600, make it easy on me, 600 billion of AI, that's too.
But is that a disproportionate share?
If you go back and you look at railroads, electrification, no. Internet, it's probably more compressed. And I think the reason it is more compressed is that the hyperscalers with Google, Microsoft, Oracle, Meta, probably leaving out a couple, well, that's a de novo company. But these are big companies with big balance sheets, and for them to do big CapEx doesn't strike me as speculative. Like for Microsoft, even for Microsoft, $120 billion checks a big, but they've got the balance sheet. They can hold the leverage.
Okay. Well, we have this left, so you were gracious to take a couple questions from the audience. So, anybody? We have the microphone here. Rob Walters over here.
Yeah, I could do that here. I want to ask you about our national debt.
Move.
I think the received wisdom is there are three ways out: austerity, inflation. I'm no economic historian, but I don't think there's ever been a nation that has grown their way out of very high national debt. Austerity, the American public and their elected officials are not too enamored of austerity as a way out. Is inflation the only way out? And my question is, where does that fit within our hierarchy of these? And is inflation the only way out?
Sure. So I do think there is the ability to grow our way out, but I think it has to be a combination of A and B. And I would add there is a D, repudiation, but that's not on the table. So just to put some real life numbers around things, in 2024, the deficit to GDP was the highest it had ever been when we weren't at war or weren't in a recession. And that was one of the reasons that I came out from behind my desk. I'd known the Trump family a long time, went to see candidate Trump then, told him I wanted to be in the economic team because I was worried that the other side wanted to go into a kind of European-style economic malaise, higher debt, higher taxes, lower growth, higher taxes, more debt, and you rinse and repeat and go into that doom cycle, which we're seeing in some of the European countries right now. So 2024, 6.97% deficit to GDP. 2025, by restraining spending and growing the economy, 5.4% deficit to GDP. I've stated that I would like to get back down to 3% deficit to GDP by the time the president leaves office. And at that point, not only is the debt stable, but you start reducing the debt to GDP. So it is possible that if you restrain spending and grow the denominator, then you do de-lever. And I think we've seen that for the American people, inflation's not an option.
Yeah, with the entitlement programs too, we got to get that.
I think this administration needs to get current spending under control, and then the entitlement programs, you got to do the short term before you can do the long term.
Okay. Yeah, right here.
Mr. Secretary.
Hang on just a sec, because they're recording this, if you can get.
Mr. Secretary, the AI has been the topic of this conversation and most conversations about the future. You talked about the sectoral effects of AI. Give us your view of the macro impact on our economy.
I think we don't know yet. I think that I think you got to have an open mind. That my 3 AI whisperers all called me within the past 10 days and said that the acceleration with AI agents to February had been the same so in 2 months had been the same that it was in the past 2 years. So the capabilities, it's really, when you think about I don't even know what this would look like. And I have an open mind, and I think obviously productivity, and we'll see what the implementation is. And then I think we also don't understand what it means for the U.S. vis-a-vis the rest of the world. That's why in my talk that imagine a world where the U.S. is so far ahead of AI. There's China, there's the U.S., and then there's everybody else. With AI, what's a call center in India worth? What are other countries going to do if we boom? Because keep in mind, European Union and the U.S. 2005, we had the same size GDP. Now are the more than 50. I don't know whether it's 100% bigger than the EU. So we've just passed them. So could you see the U.S. pull away? Maybe.
So the secretary, he is going to a rally for Trump accounts, which he spoke about earlier. And I don't know how much y'all took of that, but I went kickoff in D.C. about, 3 weeks ago or something when they kicked it off. But it really is amazing that, the Dell family stepped up for, as you said, $6.25 billion to help fund these things at $1,000, and employers can match it. And so any of you with a company that want to match it with your employees, that's something, as he said, is, I'm doing the sales pitch for you here, but yep. It is an interesting deal. I didn't know anything about it until I went to D.C. and saw it, but I think that's going to be a major, for President Trump, his major legacy.
Look, I think when we see like Mayor Mondami in New York, part of that is disaffected, mostly younger people who have given up on the system. And when you see the exact numbers, 38% of American households have no exposure to the equity market. So for the next 4 years, every child born is going to get a Trump account, $1,000 Treasury. It's going to go into an S&P fund. It is locked up for 18 years. We're going to do a ton of financial literacy. But I think more importantly, it's going to be a real-time experiment, because now every family is going to be able to look on their phone and they will care what the stock market's doing. Is it going up or down? And all those accounts can be topped up. Any child under age 18, family can open one. They won't get the $1,000, but Susan and Michael Dell are actually giving the money to the bottom 80% of income zip codes, and it's for the kids who aren't getting the $1,000. So I think it's going to, it's an amazing amount. When the president announced it, he looked at Michael and said, Michael, $250 million is a lot, but right. You did $6,250,000,000. Yeah. And so it's about $250 for every child in America who is not in the top 20% zip code. So you can adopt a school district, you can adopt a zip code. There are lots to do it. They're going to launch.
But the things for a company, if the government's giving you $1,000, a company can match it, put $1,000 in. The compounding is that right?
The company can put up to $5,000.
Okay, well, the compounding effect over that period of time for a company, if they just put $1,000 on top of the $2,000, it ends up being worth hundreds of thousands of dollars at that point.
To the children when they turn 18, or you can roll it into a retirement account and then let it roll to 60 or 65. And then studies have shown that when we hear a lot about food, families not being able to have access to good nutrition, there's also a financial services desert. And if you think about 25 or 30 million of these accounts being open, then all of a sudden, Christmas, birthdays, relatives can just drop in $20 each month. And I just think this is a game changer. I think it's going to get everyone interested in the markets. And my experience studying financial history is people who own part of the system don't want to bring down the system. I think it just does create this new enthusiasm. I think this is going to be the most important program since Social Security in terms of financial security, because for working Americans, Social Security is the bedrock of their retirement. It's the defined benefit plan, guaranteed monthly payments, but then on the other side, you'll be getting this lump sum and at age 60, or if you want to take it out, whether it's $5,000, $10,000 from just the original $1,000 in compounding, use it to start a business, to purchase a car, part of a home down payment. Because I had the Mortgage Bankers Association in the other day. They said that they have a 70% fall off rate from people who start a mortgage application and don't finish it. One of the biggest impediments is $2,000. Wow. That families can't do the $2,000 title insurance or some other payment. So I think that these things can be leveraged. Look forward to working with you all. And again, financial literacy has been one of our family's charitable endeavors over the past 10 years. So this is kind of a dream for me.
Well, thank you for coming. You're doing a great job. And